with small dollar IRA amounts. So this is a really popular topic. We love to teach about it. And Nancy has actually presented several of these types of case studies at our Battle of the Case Studies events that we host about quarterly. And she actually was the champion of our last Battle of the Scary Investment Stories that we hosted. Yes, reigning champion over here. So Nancy, I'm super excited to have you here today. Before we get started, I do just have a couple of quick announcements for you guys. This is just one of many webinars that we host here at Quest. For those of you guys who don't know me, my name is Haley. I'm one of our IRA specialists, and I really focus in on a lot of our business development, our marketing, putting on these events, and giving you guys opportunities to network with each other. Even though all of our events are still just online at the moment, we have a lot of opportunities for you guys. Here online on the webinar today with me, I have Kurt Power. He is one of our other IRA specialists. And keep an eye out in the chat. He will be posting some links for you guys to some of our upcoming events that we have. We have a webinar this Saturday. It is our self-directed IRA Saturday series that we host every Saturday at 12 p.m. Central Time. This Saturday, we have Devin Elder with us speaking about investing into apartments and multifamily syndications. So be sure to register for that event, as well as all of our other events that we have coming up. Another quick highlight is our virtual networking happy hours that we host twice a month. It's the first and third Wednesday of every month. So the next one will be on December 16th. Those are great. Last night we had 70 people online on the happy hour. It was our largest one so far, and they're a lot of fun, and you can meet investors from all over the country. So be sure to join us for those. If you guys have questions or feedback, let us know. We'll put our contact information here in the chat for you. And one last thing is, if you want to rewatch today's webinar or any of the other webinars that we host here at Quest, you can rewatch all of these classes on Facebook and now on YouTube. So we've really put a lot of effort into building our YouTube channel this year. We're posting new videos every single week. I feel like I'm recording a new YouTube video every single day. But be sure to subscribe to us on there. We've got a lot of great educational content. And if you have questions, reach out to us. We're more than happy to help. But without further ado, I want to go ahead and pass the torch off to Nancy. If you guys have questions throughout the presentation, post them in the Q&A box, and I will come back on at the end to answer some Q&A with you guys. So Nancy, super excited to have you here today. Go ahead and take it away, and I'll come back on at the end once I can kind of tell you're wrapping up.
Okay, thank you so much, Haley, and thank you, Quest Trust, for having me on. I just love doing these webinars. I think the biggest thing I love about it is, when you talk about small dollar IRAs, that, we're talking about $50,000 and less. And as I was talking to you, I said, as I've looked back over some of the case studies I've done, I've literally put together deals that equal over $1 million, $1.3 million, I think it is. And, if you think about it in real estate, okay, that's not like that much. But when you're talking about, using people's money that's under 50,000, and I've used as little as 2,500, 50,000. So it's become one of those things that it's like, I think I meet more people that have a small dollar IRA than have the big ones. Now, if you have a lot of money, if you have 100,000, 200, 3, 4, 5, all of these techniques can work just as well as with the small dollar IRA ones. But it's kind of a niche that I just kind of got into, and everything I learned, I have to give a shout out to Quest, because I went to a lot of the lunch and learns that they had starting a couple of years ago before COVID. Haley and I were just talking about, I really miss the networking and that kind of thing. So I get really excited because anybody can do this. And, it's just knowing the process and the procedure and, the ins and outs and things like that. So without further ado, well, number one, I hope everybody had a great Thanksgiving. And hopefully it doesn't look like I'm in a cave. I was talking to Haley and Juan about maybe somebody could come to my house and brighten up the back end of it, because I got all my lights on the front. But I'm going to take a second here, give me a minute, and I'm going to share my screen so I can bring up my presentation. And slideshow, here we go, from beginning. So some of you may have heard me speak. I've been investing for over 15 years now. Some of my claim to fame is not only am I a real estate investor, I'm a real estate broker. I've written a couple books. My first one I wrote was Winning Deals and Heels, and that's about my story and 9 other gals here in the Dallas-Fort Worth area. We have one from Houston about how we got started, the common themes that we all had to find out about. And then most recently, like during COVID, I put together the Profitable Landlord System, and this is my how to find, fund, and manage single family properties. That's kind of how my bread and butter of investing is. And then just recently, this is so new, I'm so excited. Last week, my second book, Let Me Ask You This. And if you've known me for any length of time, I ask a ton of questions to the point where, I have annoyed a few of my friends, I've annoyed my family. And so that's why we decided to call the book, Let Me Ask You This. And it's literally the questions that I have asked over the years about how to find funding, how to find properties, and all that kind of thing. So you can pick that book up on Amazon. I'd like to show you a copy of it, but I don't even have my copy yet. So that's how new it is. So first of all, I want to say, thank you again, Quest, for having me on. But I do want to put this disclaimer out there because a lot of you will probably contact me after this. So number one, I'm not a financial planner. Everything that I'm going to be talking about are things that I actually have done. So if you've heard any of my case studies, they're based on properties I've purchased, deals that I've put together, lending that I've put together for with the small dollar IRA. I'm not a CPA and not an attorney. And always, I just can't caution you enough to do your due diligence, talk with your financial advisor, CPA, tax attorney prior to investing. You do have to, we're talking about self-directed IRAs, but if you happen to be on, and I'll get this question all the time, like if you have a 401k with Fidelity, you have to have it with a self-directed IRA company like Quest in order to do these investing techniques that I'm going to talk about. And always conduct your due diligence on the borrower, on the property, and every investing opportunity. So the way I look at things is when I get ready to do something with a property, whether I'm buying it, I'm wholesaling it, I'm flipping it, at the end of the day, if I'm using somebody's account, an account holder to be my lender, at the end of the day, I want to know, would I keep this property? So if I'm being the private money lender with my IRAs, at the end of the day, if I had to foreclose, is that a property that I want? So that's what you need to think about. If you were saying, hey, lending me money, and well, hey, would I want that property? Now, I always pay back my account holders, but that's just kind of a due diligence question that I talk about. So people that use their IRA account to invest in real estate, again, I'm just saying the limits of liability as far as I want you to make sure that you're checking in with your financial advisors, tax liability. And I'll tell you what, when I started going to Quest Lunch and Learn, I would talk to Haley and I would talk, about setting up my accounts. The other people that were there, Quincy Long, just great resources. And the wonderful thing about Quest, I'm going to do a little shout out to you guys, is that during my course of the last couple of years of doing this type of investing, it seems like there's a little nuances that I learn, and the deal I'm going to be talking about today, I definitely learned a lot on this one. But you know what? The notes department, they are so wonderful to work with. They will walk you through what needs to be done. They'll answer your questions. They're very communicative. So I've never, ever had an issue with Quest not getting back to me, not saying, hey, we need to do this. They are so helpful. They'll direct you right where you need to go. So I can't say enough about the staff at Quest Trust Company. Story, a good case study about the options. So I do want to talk just a tiny bit about prohibited transactions. Now, again, I'm not a CPA, I'm not a tax person, not legal, but here's what I do know. So when I purchase properties, I cannot be a lender to myself. So meaning like if I find a property that I want to purchase and I want to keep it as a rental or maybe an owner finance, then my IRA or my combination of IRAs, because I can not combine them in an account, but I can use my SAP and my traditional, and they can all become part. They have to own it wholly, if that makes sense. Wholly, not wholly, but whole, in totality. So meaning like, let's say the property cost was $150,000 and I had $50,000 in my SAP. So I was going to say, hey, I'm going to use that as the down payment and I'm going to borrow $100,000 from a bank. No, you can't do that. So I either have to have the $150,000 to purchase the property. So the IRA has to own it. It has to be arm's length lending. Basically, I couldn't borrow money or lend money to my daughter, right? So there are certain restrictions. If you do have an owner finance or you create a note or whatever, so all the monies have to go in and out of the IRA. It's not like it can come to Nancy and then I turn around and pay it. It has to go back and forth. And to kind of to make that a smoother process, I always use a loan servicing company when I do owner financing. So repairs, maintenance, taxes must be paid from the IRA account. I think I said this, you can't be used to buy a property you partially own. And like I was saying, use a property management company or a loan servicing company, whether it's a rental or an owner finance. It just makes the life easier because the payments go directly to that entity and then they disperse it to Quest, who then disperses it into your account. So the first thing that has to happen if you're going to, what we're going to talk about today is buying properties. I have another presentation that talks about becoming a private money lender, but what we're going to focus on today is actually a property that I bought. So number one, you have to have deal flow. So you got to know where to find the properties, because no matter how you're purchasing them, every real estate investor needs deal flow, whether that's from your realtor, whether that's from your marketing. In my case, I have a very simple message, and my marketing is the same no matter who I market to. So I basically say, dear Smith family, I'm interested in the property at 123 Ocean Street. If you're interested in selling, call me, because it's not so much what I'm saying, it's how often I'm saying it, because you do have to be consistent. As I purchase properties with an IRA, the contract paperwork is the same. I mean, just because I'm buying it with an IRA doesn't mean, or a self-directed IRA doesn't mean I'm going to use a different contract. Now, a lot of times what will happen is when I get a property under contract, I'm not sure what my exit strategy is going to be, because I know I have a deal, but am I going to turn it? Am I going to owner finance it? Am I going to wholesale it? Am I going to flip? What is my complete exit strategy going to be? So a lot of times I'll go ahead and fill out the contract paperwork as if my entity, KBN Homes, was buying the property. Then if I decide, okay, well, you know what, I'm going to do this as an option. I'm going to do this. I'm going to go ahead and let my IRA buy this. You can always do an amendment to change the name. So don't get hung up on, what entity, or does it have to be in the LLC. I still do my due diligence. I'm telling you to do your due diligence. And I formulate my exit strategy. Like as I talk to sellers on the phone, I kind of have an idea of what my exit strategy is going to be based on the location and things like that. Now, I will say this. If you have private money lenders lined up with a self-directed IRA and you've done a couple transactions, you could probably close in as little as 7 days. I mean, that's kind of pushing it. I just recently did one where I was working with a title company that did not understand the paperwork. And that's so important, because the closing took a lot longer. And fortunately, the seller was okay with all of that. And then all the funds are directed back to the IRA. So that's the key. You have to make sure it's like you're not touching it. You're not touching that money. So here's the case study that we're going to talk about. So I think I told you that I had been investing for a little over 15 years. And the very first time I bought, and my strategy for many years was buy and hold. That's how we built our real estate portfolio. And, I used to be a property manager and all of that. And I can still remember the first time I went to go look at a property. I was in Plano, and I thought I was going to die from all of the nerves that I had buying that first rental property. If you have bought several properties, you remember that feeling. You're like, oh my gosh, am I doing the right thing? Am I paying too much? Blah, 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 blah. Is the person that's helping me, do they know what they're doing? That kind of thing. So, I probably went to that property 20 times, after we got in a contract. So now fast forward, this property, I actually purchased it sight unseen. I had a trusted person, boots on the ground, that could go look at it for me. And this is the decision. These are the pictures that I saw. What you're seeing, that's what I saw. But you know what? Here's the thing that really took me. I was like, oh, I have a deal. Is that my purchase price was only $70,000, and the ARV is 135. And because of, I'm going to get into why I knew this was a deal here in the next slide. So I was like, okay, and the repairs were approximately $15,000. Now, occasionally I'll still do inspections on properties. It depends on my exit strategy. I'm going to explain that here in a second. So this property was a 3-bedroom, 2-bath, 1961 square feet. It was built in 1953, and the rents in the area were $1,350. So the reason I'm giving you all this information is because when I acquire a property or I have it under contract, I look at two things. The first one is it going to be a property that I'm going to, keep as a rental? My criteria for rental properties is a 3-bedroom, 2-bath. Just works for me. Some people like 2-bedroom, 1-bath, some don't, so that's just what my criteria is. And my rental portfolio is based on that. So when I have properties in this 3-bedroom, 2-bath, I'm like, okay, well, I wonder what the rents are, because maybe I'll rent it. Maybe I'll own or finance it. I wasn't sure yet. So I'm doing my due diligence. Now, the repairs on this property, you can see down here on this bottom right-hand corner, that's actually a bedroom. So the seller had actually been doing repairs on the property, and they just got tired, ran out of money, many reasons. But so they were replacing the subfloors up here in Bean Home. And besides cosmetic, this was really about the only thing that was wrong. The roof was good. The AC unit was good. The electrical was probably, a little older, whatever, but it didn't need updating. And it was a fairly, clean house. So then like right there, I was like, okay, well, let's see. Then if I fix that, I'm probably going to spend, about $15,000. Now, I have two exit strategies with this property. You're probably going, well, what does this have to do with small dollar IRAs, Nancy? Well, I'm getting into that. You just hang with me for a minute. So you get the property under contract, and then you figure out your exit strategies, right? So number one, on the rentals, here's the pros and cons. So the location, it's just too far for me. This is in a secondary market. It's just too far for me. I do have a property management company, but most property management companies, unless you're with a really large one, if you have a property manager, they're usually more local to the area that you're investing in. So the location was just too far for me, and I didn't want to hire a second property manager. The age of the property was a little older for me. I normally like my rentals to be 1978 or newer. I said that before, and they're like, well, how come you wouldn't like a 2000? Well, I would like a 2000, but the 1978 is the cutoff is because of the lead-based paint disclosure. Not that I think the house has lead-based paint, but it's just one more piece of paper that I have to make sure if you're renting it, because a tenant, when you have tenant turn, anybody that lives in that house has to sign off that that you don't think there's any lead-based paint and that they are acknowledging that. So it's a disclosure thing. As I said, I would have to hire a property management company, and I knew I was going to use an IRA for this property. So I also knew on a rental that all of the expenses, so that $15,000, if I had to get it all up and running, I'd have to take out the money from the IRA, and any income would have to go back in and out. So that's a lot of accounting paperwork that I just wasn't really, at the particular time I was buying it, I just was too busy. Or I could owner finance this property, because this is what I love about owner finance. You don't have to really fix up the house a whole lot, because you're owner financing it, and everything is negotiable. So the location was perfect for owner financing. The age of the house didn't matter, because I was going to owner financing. I'm going to put a loan servicing company in place. So they're going to take the buyer's payments, and they're going to, then the loan servicing company then disperses to Quest Trust Company, and then Quest Trust Company then disperses to either my IRA, or in this case, I had Quest account holders that were my lender on this property. So, and then I don't have to worry about, I get a text message and an email that a deposit was made. So it's so simple. So that's the route that I decided to go. So what was the outcome? So I purchased the property for $70,000. So I've worked very hard, and I have a great network of private money lenders. And so I'm just going to say a little bit about private money lending with your self-directed IRA. Number one, it's very relationship based. I've listened to Brant Phillips. He's wonderful. He's also been a presenter at Quest. And he talks a lot about this, about it's very relationship based. People, what they will do business with people they like, know, and trust. So the two people that lent on this property, there were 3 accounts with 2 different Quest customers, if you will. They were the account holders. They had self-directed IRAs. They've done many deals with me. So it's a phone call. It's like, hey, is your IRA available? Yes, it is. Great. I have this property under contract, good. And since they've done it with me, they know the paperwork, they know the time frame, because one of the things, if you're going to either be a private money lender with your self-directed IRA, or you want to borrow from other people, is that number one, there is a set of protocols, set of process, paperwork, and then time is of the essence, because there is, when you have a title company that knows how to do the correct paperwork, it does have to go back and forth a couple times between Quest and the title company, because they're ensuring that the paperwork is correct and everybody's got to sign off on it and all of that kind of stuff. So in this case, I reached out to my 2 account holders and I told them, so one had 40,000 and the other person had a total of 30. She had 2 different accounts. One had $8,000 in it and the other one had 22. So I put her 2 IRAs to work. I paid them 2 points or $1,400. And because I've done business with them and they know I like to keep their money busy, I've negotiated paying them 8%. And they're quite happy with that because I keep their money. And I typically go a little bit longer. Like if you've used hard money lenders before, you've done 6 months, 12 months. So I've done as long as 5 years. It depends on the account holder, what type of account it is, and if they have the time. Because let's get real, if you have, let's say, an ESA, an educational Cloverdale. I always want to call it Cloverdale, but Cloverdale. I think I'm saying it right, Haley. Well, let's say that your child is 5. They're not going to go to college for a few years. So wouldn't it be good if you could tie up that money for 8 years at 8% or 10% or whatever it is, whatever you're comfortable with? So, those are some options for you, because any type of IRA, Roth, traditional, SEP, checkbook, ESA, HSA, I might be leaving out a few alphabets there. You can do this if they're self-directed, if they're self-directed with Quest Company. So the fees for the borrowers, meaning that, so there is a fee when money comes out of the account. Now, when you put money into your Quest Trust account, there's no fee. Like when I get a check from the loan servicing company, it goes right in there. There's no fee, but there are fees because they have to, do the paperwork or whatever for when the money comes out. So I pay those fees for my borrowers. So my borrowers, the only thing they're not losing out on anything. So I'm paying their fees, I'm paying them points and that kind of thing. And then my closing costs were, we estimated around $2,500. They were just a little tiny more than that, but that was okay because, so that's how I bought it, right? That was the purchase. I used 2 account holders who had 3 self-directed IRAs. We did all the paperwork. And one of the things that I do for folks is that when you are a private money lender with me, I actually complete the packet of paperwork and send it off to you because, calculations have to be made and that kind of thing. I'm not going to get into all of that today, but there is a certain format that Quest needs to have the paperwork so they know of these 2 people who has what percentage of, it's called undivided interest. So I'm probably getting in the weeds a little bit too much there. Okay, so what did I do with it? Well, I owner financed this property pretty much before I closed it, right? Because I have a list of buyers. And I sold the property for $115. Now, what did I buy it for? I bought it for $70. So I sold it for $115. The buyer, 10% down or $11,500. Now, because I'm kind of the, I didn't want to hold this for a long time. For my own personal investing reasons. And so I said, you know what, I need that buyer to refinance out of this within 12 months. Now I had done my background check on the buyer, so I knew that would be a possibility. And then if not, maybe I'll sell the note. I don't know. But anyway, that was what we negotiated. The buyer had to pay me 2 points. Okay, so let's look at this. I paid my lenders 2 points. I paid them 14, but I'm charging the buyer 23. The buyer is paying 10% interest on the money, right? I'm only paying 8. So I'm borrowing over here on 8%, 2 points. The end buyer is paying 10% and 2 points to me, okay, to my IRA. Okay, let's clarify that I'm doing it through an IRA. So their payment ended up being about $958. And I make the buyer pay the loan servicing fee, which is $35. So in this particular example, this case study, Nancy had zero money coming out of pocket. I didn't have any because I was going through my IRA. I used an option on this, which is another case sitting out there, and you're like, how did she not know that? How did she not know that? Because maybe you knew about it. And you know what? I've gone to all kinds of conferences and read about it, and the way it was presented was so convoluted. I was just like, and I'm not talking about Quest, because I don't think that I've ever, in fact, I know I haven't, I've never heard Quest talk about this particular option. I've heard a couple of people, how they did it, but I didn't really follow it. And there was like trust and all of this. Anyway, someone told me how to do it. And I was like, oh my gosh, that's so easy. Yay. So my IRA is able to take ownership, and it can still be in rental, or it can still be a owner finance deal. So I decided, and you'll see the next slide on how I did, why I made the decision I did to use an option, because I didn't have to do that. I still wasn't out of any money. I could have, all of those funds that you just saw, I could have just taken them, right? The 11,500, the 2,300 and points. I could have just taken them, meaning just paid directly to my entity. But the way I did it is I had it paid to my IRA. And you're all going to just be dying about how I did this. Another case story for another time. So how did I do though? So I think I did pretty good on this one. And this is part of the one I was going to tell Haley about for next year. So you guys are getting a preview about how I might take the title next year. So my expenses for my IRA were $1,400. And I'm going to be paying about $5,600 in interest, because the way I set it up with my account holders is it's an interest only loan from them. So they're letting me borrow their money, and I'm only paying them interest. I don't have a principal payment. I'm just paying interest. So my total acquisition cost from my IRA was about $7,000. Now I'm getting into my IRA $11,500. So that was the purchase. Okay. Now the sale. So my profit, meaning $11,500 was the down payment, goes right back into my IRA. So what did I say? My total acquisition was around $7,000. So I'm already up $4,000. The point difference alone was $800, which is included in that. So I paid $14,000, but the buyer was paying $23,000. The interest difference in what I'm paying and what they're paying is about $5,500. And because I'm having them refinance out, I'm going to net $28,000, not Nancy, but Nancy's IRA, my SEP IRA. So my total profit on this one transaction where I used an option of $100 is going to net my IRA, my SEP IRA, $46,296, or 617% return on my investment. Now, at the end of the day, I'll take that. And here is a little tip. And for those of you that are really, CPA tax savvy, that kind of thing. So if I had just flipped this house, if I had just owner financed it, sold it or whatever, and, refinanced, when I got the total $46,000. So let's just say I got some of that money. Let's just divide it in half, $11,500. If I'd gotten it in 2020, I would be paying a chunk of change on the taxes. When it went into my IRA, $0 until I take it out, right? So deferred taxes, okay. So let's just say the $46,000. Let's just say she refinances next year. And I've netted $46,000, right? So now I would have to pay taxes on the entire amount of $46,000. But the way I structured this deal, So let's say all that money goes into my SEP IRA, but maybe one year I take out 5, maybe one year I take out 10. I don't know, maybe one year I want to, go to Europe and have a really good time and I take out all 46. But do you see how I'm able to control when I pay taxes on that money by doing this? And this was a game changer for me, guys. I mean, if I can take $100 from my IRA and then turn around and make my IRA $46,000 tax deferred, until I decide when I'm going to take out that money, because what I could do with that money now, it's in my IRA. So now it's just increased my IRA by that much more value, cash value, and I can just go out and continue buying properties. And just so I do get asked, hopefully I'll be able to get to some of the questions that you might ask, but one of the number one questions that I get asked when I do these presentations is, do you have, so like these two people that, loaned me or lent me the $70,000. So it was 40, 20, and 8. Okay. Those were the 3 balances in their IRA account. Do they get combined? Absolutely not. Okay. My husband and I, we had small dollar IRAs and we combined them. We have 3 IRAs that own one property. Okay. So we were able to we acquired a property for like $60,000. For those of you that have heard my story about my $5,000 property that I bought a property for $5,000. That's how my journey started. Well, it was so popular that I've given the speech many times for Quest, but a guy named Ken Corsini, he used to be on Atlanta HGTV. They reached out to me last year, and that story, I'm on page 121, chapter 12, is the story of how I took $5,000 from my husband's IRA and we purchased a property. I had a partner. My partner paid cash $5,000. So we literally bought this house for $10,000, sight unseen, didn't know what we were going to do with it, stuck a sign in the yard, English and Spanish, and we owner financed that house for $50,000. Here was our terms. 20% down. So we got our $10,000. I got $5,000 back in my IRA. He got his $5,000 cash back. And we are holding a note for $40,000 at 9.8% and 9.5, something like that, on the $40,000 for 15 years. And it's every month like clockwork. We have a loan servicing company in place. We just get a text and an email, a deposit's made to your account, deposits made to your account. So it's just been very enlightening about how you can grow. And again, that's all tax-free, because not tax-free, tax deferred. And so one of the presentations I did for Quest is we actually compared what he was paying in taxes, although it's a small amount, but he's still paying taxes on that money he's getting as a passive income. So anyway, it's great fun to learn how to do this. Oh, here we go. So now what you must know. So this last transaction, although, I am going to make a pretty penny on it, it was a painful process. And the reason it was a painful process is, unfortunately, the person that I was working with on the other end wanted to use a particular title company, and they just didn't understand the paperwork. Number one, you have to have a title company that understands how to structure the paperwork. Last year I did another deal with another title company, and I said, have you guys done this before? And they said, no. And I said, well, but if you show me, we can do it. And I said, well, if I can show you and your attorney how to do it, then I don't think I should have to be paying your fees. So it's not that it's complicated, but there is a certain way that the deed of trust has to be structured. So this title company, I kept telling them, you only need one deed of trust. They tried to do 3 separate deeds of trust. Guess what? When it came back over to Quest, they're like, no, then somebody was out sick. And so it did take it was very painful. Let me just tell you that. And not anything from Quest or not anything from the account holders, simply because we had a title company that just wasn't familiar with how to, I was purchasing, and then we did owner finance. And so they were, same title company, and they were so confused. We actually finally got they've been sitting on the file since November 19th. It just funded today. Thank you very much. So, that was after me calling them. So you set up all the terms prior upfront prior, making sure all the documentation has the exact same percentages, verbiage, and order of lenders. So in this example that we were talking about, everything, it all goes on the deed of trust. And it also helps me. I'll just give you a quick example. A couple of years ago, I did one where I had two account holders. We only needed $8,000. One lady had 3,000, one had 5. But because we were buying the house subject to, we were, they would be in second lien position, right? And so I said, hey, look, guys, you guys are going to be in second lien position. They were okay with that because they know it's me. Now, if you come to me and say, hey, would you be in second? No, I'm not going to do that. But they knew it was me. I have a reputation, you know, they pay back my lenders or whatever, and they were happy to do it. We paid them 10%. They got 2 points because their money was getting 0. Right? So we were able to help each other out. I was able to put their small, really small dollar IRAs to work. And, you know, and since then we've paid them off. But we had another situation where we've used like 3 different people with 3 different self-directed IRAs, 10,000 each. And they went 10 years because they could, right? So, you know, when you are building your network, you want to be very transparent. So the other part of this is having a JV agreement, because this has never happened to me and I don't anticipate it ever happening, but there's only one deed of trust and you need to have a JV agreement behind the scenes, so to speak. So when I'm borrowing from my different private money lenders, we have a JV agreement. Number one, if something goes south, it needs to be written down what is going to happen, because I don't want my account holders ever to feel like, oh, well, I don't want this property, or what if you have to foreclose or whatever. Never had to do that. Don't anticipate ever having to do it, but it's just a good step to have a JV agreement. And like I said, you do have to make sure you have a little bit more time. Like if you're trying to close something in 3 days, I mean, maybe it could happen if you know what paperwork has to be done and you're working with a title company that knows. So you have to have the right players knowing all the right info, but you should give yourself, you know, 10 business days to really get it done. That's about the fastest I've seen it. And I don't really think because there's so many moving pieces, if you have multiple people, you don't really want to rush through it. You want to make sure everything's right, because it can hold up funding like what I just went through. So, so make sure that it takes a little bit more time. And if the title company has not done it before, if they've never, then change title companies. I'm just telling you, you might have a favorite title company, but if they don't know how to put this paperwork together, just save yourself a lot of headache and find one that knows how to do the paperwork. So, and then once you've done it and you're familiar with the paperwork, then you can walk them through it. But if it is your first deal, your first, you know, you're working with account holders, it's their first deal, don't put the stress on yourself. You'll just be going, what? So, okay, so that's my case study for today. Now, I have a couple things. So I have been asked so many times, how do you do this? How do you get started? So I actually created an online course that y'all can take to teach you everything I know about how to invest with a small dollar IRA. It's about 2 hours long. You need to email me at nancy@kbnhomes.com if that's something that you're interested in, and I'll send you out some information. So in December, because it's the holidays, I want to give back. I'm doing like a half price sale. So I want to make sure I give that to everyone that was on this particular webinar today. And I will also send you a copy of my new book. Let me ask you this. And one of the things I do not only on the course, but in the book, is you have links to all my downloads. I'm going to give you a copy of the deed of trust, a copy of the JV agreement, a copy of the option agreement. And here's the thing, if you follow everything I say about in this course and you don't make back your money in your first deal, I will refund the cost of the course to you. How can you beat that, right? And I tell everybody, you know what? Because they'll say, well, how do you do this? And it takes about an hour just to kind of walk you through it. So once you do the course, then I also am offering everybody like a free call with me, just to say, hey, what can I do? How can I do this? And I'm telling you, I am such a believer in using your small dollar IRA. I have another slide I was telling Haley about that, as I said in the beginning, that I have put together in less than 2 years, 1.3 million value of property using IRAs that usually average somewhere between 15 and 22,000. So that might not seem a lot, like if you're in multifamily or whatever, and you're, raising 2 million, 3 million for just one deal. But think about that. Of all the people that have small dollar IRAs, so that's not like big numbers, like it's anywhere from the smallest I've used, now I've used 100, all the way up to 50, and putting deals together that have a value of over 1.3. Okay, then. And the average number of private money lenders I have on my sheet is usually 10. So it's not like you need trying to get my Instagram thing going, whatever that is. So in between all of this. So I hope you've enjoyed it. I always enjoy giving these presentations. It's so fun because people are like, whoa, how'd you do that? And I want to teach you how to do it. So, all right, Haley, I'm going to stop my share now.
Awesome, Nancy. And if you want to go ahead and keep your screen shared, that way everyone can see your contact information.
Oh, okay. Let me do that. Let me get that bad boy back up.
Awesome. And we do have a few questions, guys. If you have questions, be sure to send them to the Q&A box. We'll try to answer as many as we can. But let's see. I'll wait till you get your slide pulled back up.
Yeah. Okay. There we go. I think, is that going to work? What happened?
Click like the back button, maybe like the left arrow button.
There we go.
Perfect. Okay. So I have the questions pulled up here. This is a good one. Someone goes, maybe I missed it, but what did you say was the reason that you don't combine the IRAs? You started to say that the first guy contributed, his 40,000, 57%. Does that mean that he would get 57% of the profit from that deal?
Yes, that's exactly what it means. So that 1,400, and here I have my calculator. So that 1,400 times 0.57. So he would get $798 of that. Let me just quickly do that 8,000. So that kind of 1, 2, 3, 5 by 70. Okay, you guys are asking me. I think that's about 12%. 1,400 times 0.12. So the 8,000 person would get 168, and then the balance, and then the monthly payment of 467. Same thing. One guy gets 57. And the cool thing, this is once you do all of this up front, so when I put these deals together, I'm the one that, has to calculate. Quest doesn't do that. Don't ask them to do it. They're not going to do it. So what happens is I will actually do an Excel spreadsheet, which I include. I include in the course how to do this, right? And it's pretty basic. It's the round up, the round down. And it can't change, right? So one time I had a guy, we already did the deal, went through all the trials and tribulations, only for him to send me an email it should have been 0.1111. Well, you know what? When you're talking about dollars and cents, nobody can take, 467 and make it 0.673333. So it has to make sense, right? So all of that is in the promissory note, because I think I might have left that out. When I use the account, there's a when I'm borrowing money, there's a promissory note. I'm promising that I'm going to pay the money back. So if for some reason it goes, south, the lenders, the account holders have something to hold me accountable. In that document is who gets what, and on the deed of trust, it literally says, Quest Trust Company for the benefit of name of account holder, account number, and then an undivided interest of 57% or whatever it is. So on the combination, they come together to become a percentage of ownership on the property, but the funds literally are not mingled, if that makes sense.
Mm-hmm. Yes, and if you guys still have questions about that, just give us a call at Quest. We see a lot of people that use this strategy to partner IRAs, so we can always help to walk you through it, as well as the education that Nancy offers as well. This is another good question here. Whenever you get private money lenders, do you aim to fund the entire purchase price or just enough maybe for a down payment?
Oh, good question. So I'm all about other people's money. So I borrow the amount I need to usually purchase the product. So in this case, you'll notice I didn't borrow because I don't believe in borrowing more than you need. So I purposely only borrowed the purchase price. And then my IRA had enough to cover the closing costs, but here's the thing. When I did the owner finance thing, I negotiated the price, and I basically said to the end buyer, you will reimburse me. So if my closing costs were about, I think when it was all said and done, they were about $3,000. That money came out of my SEP IRA when I purchased, right? But when I owner financed it, the end buyer, part of their closing cost was to pay my original closing cost. So technically I had no, so they had to pay me back $3,000 in addition to their closing costs. So I negotiated no closing costs on, except for the tax part, on the sales side. So they had to pay me. And that's the beauty of either using private money lenders, owner financing. Really, you're not constricted to like, a bank, and all their rules. It's very negotiable. The buyer could have said no, but they wanted a house, and that's how I wanted to sell it. I wanted no money out of my, I didn't want to have any money lost, if that makes sense. So.
Awesome. And then just to kind of add on to this answer a little bit, Eduardo, the second part of his question was about UBIT. So I just want to make a quick little distinction here. So if I'm using my IRA to say loan Nancy money for her deal, whether my IRA owns loans the full price or just part of what she needs for that, Nancy, the individual, is the borrower in this case. So that would not really trigger UBIT. Where an investment might trigger UBIT is, say, if my IRA was actually purchasing the property, and so my IRA got the loan to leverage the funds, that would trigger UBIT. So Eduardo, just wanted to clarify the second part of that question for you. But if you're just using your IRA to be a private lender, doesn't necessarily trigger UBIT through that scenario.
And I was told, because I did check into this, because it could trigger UBIT, but my UBIT tax will still be less than had I flipped that money. You know what I'm saying? So, and I'm knocking on wood, and I don't want any IRS audits or me. But you know what? That's the great thing about working with Quest Trust Company. Not that they're giving you legal advice. They're not, but they are there as a resource to say, did I complete the paperwork correctly? Did I fill in all the boxes and all that? They're not giving me financial or legal advice, but they are assisting me in making sure I correctly, got the asset into my IRA, or I took the asset out, or because I've actually, sold, and I've done a lot with my small dollar IRA. And I'm just telling you, they have been there every step of the way.
Awesome. Let's see. We have a few other questions here. Not sure if I'm exactly sure of what Jeff is referring to here, but Jeff wanted to know, are the borrower fees above and beyond the quarterly fees that you pay Quest? How do you handle this? Do you usually have the borrowers pay the Quest fees, or do the account holders do that? Let's talk a little bit about that.
Okay, so what I do, well, number one, I tell all my small dollar IRA account people, make sure those fees are being paid outside your IRA, right? Because you don't, especially if you have like 5,000, 8,000, 3,000, you don't want those fees to be in there. So I pay, now I don't pay their maintenance fees. I pay their fee for me to borrow their money. So it's usually like, I don't know, I could be wrong, Haley. It's usually like 125 to 150. It's a pretty small fee for me. It's a fee. I just look at it as a fee of doing business with them. And they would have to pay that because it's not transfer, but it's like a maintenance fee to do the actual, take it out of the account, move it over here, that kind of thing. So so Jeff, I think it's two parts. One, I don't pay their ongoing fees. I pay the fee for them to take the money out. Does that make sense?
Yes.
So they're, yeah.
Awesome. And then Susan had a question here. So basically, say the IRAs are partnered in the deal, they're, collectively loaning the funds out to someone. Now, when that borrower goes to make the payments back to Quest, and you probably know this, but I'll kind of let you elaborate this. Does Quest divvy those up? Do they have to send different payments? What's your experience with that?
Okay, so once everything is in place, it's so seamless. So basically, what'll happen is it'll go to, I'm not sure the right department, Haley, but it goes to Quest. Quest already has who gets what, right? They know that 200 goes to Nancy's SEP. And so I just got a text today, and it's from the loan servicing company. And they said, we received, your deposit from Quest, or it's actually from Quest. And it'll say 9611 went into that, IRA account. 489 went into this one. So it's very seamless. So Quest gets one payment from the loan servicing company, or it could be when I borrowed money, I've sent checks to when I've been the borrower and I've just not Nancy's IRA, just Nancy's entity, then I would send a check to Quest for a property that I borrowed money on. And then Quest took that one check and then distributed it based on the paperwork that had been completed for the transaction. So hopefully that makes sense. Once it's all set up, so seamless. And you can actually pay online, because I know that this has happened to me before, where you can actually pay online. So I can go into Quest and I can make my payment. And then when Quest gets it, whatever accounting department or whatever that is, then they're the ones, they already have so look at it this way. It's like a recipe. You bought the house, you already know what all your terms are going to be, what each lender is going to be paid back. And Quest has that. They have the recipe. So they know, account holder 1 gets this much money. Account holder 2 gets this much money. They're not concerned with the percentage, because remember I said they don't do the percentages. All they're doing is the amounts, which you have already calculated and provided during the course of the transaction.
Mm-hmm. Yes, awesome.
It becomes part of the closing documents, if that makes more sense.
Mm-hmm, exactly. Yeah. And basically, anytime we receive a payment here at Quest, they could either send us a check, they can go through our online ACH portal. There's a lot of ways to make it really easy, and we'll basically divvy it up between the different accounts based on those percentages of ownership for that investment.
And I'll just say one more thing about that, Haley, because I've done it both ways, where I do a monthly payment. And then in the case where I had the really small, their payment, one payment was $42 and the other one was $25. And so in hindsight, what I could have done if I had negotiated, and I only held it for I think 8 months, rather than making that it was a $67 check every month. I could have negotiated with my account holders, hey, is it okay if I just pay you out at the end of the transaction? And so when I first did it, I was like, oh, I should have done that. Well, when I did another, I borrowed $15,000 from another account holder for repairs on a property. We were buying it subject to, we just needed the money for the repairs. And so I said, hey, you know what, we're going to flip this house. I just want to borrow, and I'll pay you everything when I close. So I paid her points up front, but all the interest, and we held it for maybe 8 months, and she was completely fine with that. But the paperwork was all written up, and all of that was negotiated up front, agreed to, and then becomes part of the closing documents.
Mm-hmm. Exactly. Yes. All right. So we have time for just maybe 1 or 2 more questions. We've got actually 2 good ones here that I like. Eduardo has another question. For the fix and flips, are these loans structured as promissory notes with fixed interest? I can understand more complicated structures for rentals, but how about for these quick transactions?
So again, everything is negotiable. It's what you're willing to pay as the investor. Now I will tell you this, for fix and flips and super quick, I find, using the small dollar IRA is probably not for me, because it's just too much back and forth. You know what I mean? I have to get the money for the repair, unless you've negotiated to get that. Like in the one I just talked about, we negotiated that we got the full $15,000 up front. So I didn't have to worry about going back to Quest and getting this and all of that. So on my own properties, if I think I'm going to do a fix and flip, I'm definitely not going to do an IRA at this point in time, just because it's too much back and forth. It's quick in and out. And but as far as a rental, so maybe I'll use a hard money lender. And I did do this. I used a hard money. You can negotiate whatever you are willing to do, and you have a willing a partner, so to speak. So very flexible, and think outside the box. I think that's the cool thing about not being restricted to, I have to do it this. Yes, there's rules that you have to follow when you're going to use self-directed IRAs, but as far as terms and things like that, that's all negotiable between the parties.
Yes, yes. It's all relationship based, which is one of
Mm-hmm.
the great ways or great reasons to use private money. We have one more question here, and I really like this one. Medina wants to know, you mentioned that you bought a property sight unseen. Did you have the buyer sign a preliminary agreement until you did your due diligence with an option to terminate in 24 to 48 hours if you changed your mind? If so, what type of agreement did they sign?
So I did not. And so I bought two properties sight unseen, and I did not. And you know why I could do that? The numbers I had so much room in the numbers. And the other thing, I mean, I'm a real estate broker as well. I know the areas that I'm marketing to. So a lot of it has to do with knowing your market, knowing what is selling, what's happening, owner financing or whatever. So the example of the house for $10,000, we bought that sight unseen, and that house was a wreck. I mean, you should go back and look at that house. But you know what? I knew it was in downtown historic Fort Worth. I knew we had a deal. I didn't know what I was going to do with it, but I knew we had a deal. I mean, when you can't buy a house for $10,000, you can barely buy a lot anymore for $10,000. So it's about knowing your market. And because I market to certain areas, I'm very familiar with ARVs, the after repair value. So I only do that when the numbers are so good. I just like, oh my gosh, I have to get this house. You know what I mean? Now, and again, I had a trusted boots on the ground who's also an investor, and I've worked with him before. So, I had some things in place. It wasn't like I was just like, oh, hey, I'm going to buy this house. You know what I mean? I put some things just because, and so I did not have the buyer sign anything. And typically, what I do is I'm not a pay them $10 this and $10 that. I'm, like, if I'm going to purchase your house, I want to put I'm going to pay you $150 option fee for a 7-day option period, 7-10 days or whatever. I think we did the same with that one. That's pretty standard for me. So I could have, but I just chose not to do an inspection on this house, especially as more time went by and I was like, dang, I'm going to owner finance this thing. So it is about doing your due diligence. And no, I don't have a seller sign. I've never had a seller sign this. If you write the contract right, you don't have to.
Exactly. And we actually did another great class specifically over the TREC contract several weeks ago. You guys can email us if you want me to send you that class. Email us at, let me drop our email in here really quick. IRA specialist at questtrust.com. Send an email to that email address if you're interested in our class that we did over the TREC contract. It was actually my dad who taught it. He's been in real estate for like over 20 years, flipped 1,700 houses, and he has some great nuggets about that option period and section 24, I believe, of the TREC contract. Some definitely important things there that you want to be aware of. So that's a great class. I can send it to you guys. Just send us an email there. Nancy, that's about all the time we have for today.
Okay, well, thanks again, Haley.
Yeah, this was so educational. Before we sign off for the day, do you have any kind of last closing thoughts or statements that you would like to leave our audience with for the day?
Well, if there were some questions that people had, just send me an email. I do have a checklist that I use for growing my IRA. And, if you would like that, just send me an email at nancy@kbnhomes.com and I'll send you that. If you're sitting on the fence and you just think about this, if you have a small dollar IRA and you're just not sure what to do with it, but you don't want to put it in the stock market, then you really owe it to yourself to get educated, how to do this, buy properties. Like I said, enough. If you want to be passive, we talk about how to become a private money lender. So it's a way for you to get into real estate investing that's more secure, backed by real estate. And
like a stuffed Questie, some other little freebies if you open up a Coverdell in the month of December. So for all of you people out there that are partnering your IRAs together, if you've got kids, you're wanting to save for their education, partnering a Coverdell in on your IRA investments could be a great way to do that. And these booklets came out so cute. We just got them yesterday. We'll be posting more information.
They look adorable. I love the pig. It's so adorable.
Yeah, there's a little crossword. There's a little find the Questie. It's super cute. So guys, we'll be doing that all month. Nancy, thank you so much for joining us today. Guys,
thank you, Haley. Thank you, everyone. Appreciate it. And get out there and happy investing.
Awesome. Have a great day, everyone.
Bye-bye.